would say as expected, at least as of now, right? The retest that we're seeing this week, I don't think it will lead to a test of the October low. I think we'll see a higher low relative to that, and I say that largely because of the intermediate term setup. We had the deepest oversold condition, as you know, in October that we hadn't seen since even the presidential election low, so the timing of that's pretty interesting as well. So I think as we come off of this, we have this little pattern setting up. It's called an inverse head and shoulders. A breakout above about 28.12 to 28.17 by the S&P 500 would complete that pattern and really support a nice rally into year end.
That's what Mike Santoli was talking about.
The inverse head and shoulders. What has resonated with me, though, is that the fear hasn't been deep enough, or the urge to throw in the towel and say, you know what, I am worried this is more than it. I'm starting to see some signs of that. I'm starting to see sell-all rallies. I'm starting to see this isn't a correction, or it's a very deep correction, or this is the beginning of something much more than a correction. You're starting to see that with maybe a third of the players. But there's still the idea that, oh, we're going to weather this garden variety correction and we're ready to head back up. And I'm just wondering if you've wrung out enough of that complacency. Do you think?
I think so, because and my conversations go the same way. But when I look at the measures, the transactional gauges of sentiment,
the actual people acting instead of talking.
That's exactly right. So they're extremely, extremely oversold or extremely bearish. You know, the VIX could be higher, of course, but when you look at other measures, it's really to the point where it's totally set up for a relief rally that's more in earnest than what we've already seen.
I think, has conjured up some of the fear and complacency getting wrung out that we've talked about. Because, you know, more and more, as Kramer's pointed out, more and more people, analysts, are finally, you know, that we're universally bullish. Now there's a different downgrade every.
A lot of people have piled on, yeah.
Apple's a proxy, maybe somewhat for the leadership.
As a technician, I can't help but look at Apple and get excited, right? It's a corrective phase. We rarely ever get them. Gaps down occurring near the 200-day moving average, they tend to be exhaustive. So for me, it looks like an entry in Apple. And when I look at the former leadership of the market, technology, consumer discretionary, even retail, I think we have some opportunity here to add exposure, at least for an intermediate term up move. So if that loss of momentum that we saw in October is lasting, I still think we get the intermediate term up move, and that's how we want to position.